they often say, well, it's totally divorced from trend following. Our bottom-up process, which is the majority of the weight, we weight it 30% top-down, 70% bottom-up, is a trend-following strategy. Our replication approach is truly applying trend-following signals. I think a lot of people get that wrong when they talk about replication. We just find that the top-down does seem to work just as well as the bottom-up, and provides process diversification. And so we find it's better if we blend them together.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome to another episode in the Open Interest series on Top Traders Unplugged, hosted by Moritz Siebert. In life, as well as in trading, maintaining a spirit of curiosity and open-mindedness is key, and this is precisely what the Open Interest series is all about. Join Moritz as he engages in candid conversations with seasoned professionals from around the globe to uncover their insights, successes, and failures, offering you a unique perspective on the investment landscape. So with no further ado, please enjoy the conversation.
Hey everyone, and welcome to episode number 16 of the Open Interest series on Top Traders Unplugged. Today, as a special, my Takahei Capital business partner Moritz Hayden will join me as co-host, and we'll be speaking with Corey Hoffstein and Adam Butler from Return Stack Portfolio Solutions about trend following and portable alpha ETFs. Corey and Adam started the Return Stacked ETF business together with Michael Philbrick and Rodrigo Gordillo from Resolve Asset Management and launched their first ETFs in 2023. Since then, they have been expanding their suite of return stacked investment products significantly, now spanning a variety of portable alpha solutions from trend following, multi-asset carry, merger arbitrage to Bitcoin and gold. We'll focus on Corey's and Adam's approach to replication, the complexities that go along with it, and we'll also discuss some of the challenges associated with putting an active trend-following trading system into an ETF wrapper. So, Corey and Adam, welcome to Open Interest. Great to have both of you here.
Thank you for having us.
Thanks. That was a great intro.
Well, thank you. Well, we learned from the best, from you. It's been... We were just, before we started, Moritz H and I, we were reminiscing when we first got in touch with each other. And I think, I ventured to guess that it's probably 10 years ago. Moritz said, no, it's probably not 10 years, must be less, maybe 6, 7. But I remember we were reading Corey's stuff from Newfound Research. And we've been chatting about the Bitcoin basis trade and rebalancing timing luck and liquidity cascade. So it's been a couple of years, and it's great to finally have you on.
Time flies fast. I would guess it's probably 10 years now we've been chatting. So yeah, it's been a long time.
There you go. All right. And it's really great for me to have Moritz here, the two Moritzes, the two Kwans as a co-host. Moritz has helped me to come up with the smart questions, which he's very good at. So why don't you kick it off?
Sure. Thanks. Hi, guys. Great to have you on the show and also great being here. Now we've already heard a little bit about the things that you guys have been doing. And I was specifically interested in the background on the return stacked idea and the strategies, maybe also giving the listeners a little bit of an introduction into what return stacking actually is and where it came from and how you came up with the idea and also why you launched that product in the end, or that suite of products actually.
Yeah, so I will do my best to breeze through this in a timely manner. So as you mentioned, return stacking is synonymous with this idea of portable alpha that's been around since the 1980s. PIMCO was really the progenitor there. It's been an institutional concept. And the idea is basically, how can you keep your beta in your portfolio, the core stocks and bonds that institutions are building their strategic asset allocation around, but search for alpha in more fruitful places, right? if you're allocating to stocks, do you have to try to find alpha in picking stocks, or can you just keep the beta and use financial engineering, use capital efficiency through futures markets and swaps and other capital efficient instruments to free up capital in your portfolio and allocate to more fruitful sources of alpha? That concept has been a mainstay for institutions for the last 40 years, but has largely been out of the reach for most individuals and wealth managers who aren't going to manage a book of derivatives themselves. And so return stacking is our attempt at encapsulating that idea into tickerized solutions so that people can buy a product that gives them that implementation without having to manage any of the behind the scenes process. We are going to manage that from an institutional perspective and give them a variety of flavors. As you mentioned in the intro, so Adam and I are both technically from different firms. Return Stack Portfolio Solutions is a joint venture between Adam's firm, Resolve Asset Management Global, and my firm, Newfound Research. And we both really came to the idea of adopting portable alpha as a solution independently. Same way we're talking about, I go back a long way with you guys. I go back a long way with Adam and his partners as well, probably almost 15 years at this point, sharing collaborative research. And we both came up in the 2010s offering alternative investment strategies and just struggled against the nonstop outperformance, particularly here in the US, of a core US 60/40. And sort of by the second half of the decade, realized that perhaps there had to be a better way. Rather than telling people, sell some of your core stocks and bonds to buy alternatives, have that constantly be a disappointing approach, we started exploring other ways of implementing alts, and portable alpha came up as this solution. And so in fact, I actually was invited to a Barron's roundtable about ETFs in 2017. I said I thought capital efficient ETFs would be the future in 2017, and gave this exact example of, hey, if you have a capital efficient ETF that gives you simultaneous stock and bond exposure, you can use it to introduce alts, without giving up core stocks and bonds. There was a large conversation going on in FinTwit at the time. I don't know why it took us 5 or 6 years to actually get an ETF out the door. Sometimes things are easier said than done, but I think both of our firms came to this idea as a solution of solving both the practical and behavioral issues of trying to get investors to adopt and stick with alts. Now Adam can add some extra color here. His firm has been doing this stuff for a long time. A lot of their mandates have been futures-based. They've been blending active strategies with risk parity solutions for most of their history. So they've been implementing this idea of portable alpha and return stacking in a different way. I think what we've done with our ETF solutions is try to distill it and simplify it into core building blocks that wealth managers can use to build whatever sort of portfolios they want for their clients.
And I think you've done a great job educating the space and kind of like putting it on the front, because as you said, like portable alpha, return stacking, which is the term that you're using and you've coined it, core satellite, this stuff has been around for decades. Sometimes people didn't even know that they have it in their portfolios. For instance, through QAS strategies, some of them have this portable alpha concept, and like just, a risk parity type of bond and equity allocation, depending on which level of vol you run it on, is something like a portable alpha product at the end of the day. So you've done a great job putting it out there, like you said, creating a tickerized solution and building a suite around that. And what we now see, quite interestingly, the US market for active ETFs and your types of products, trend following ETFs in particular, is growing very fast. There's more and more firms entering the space. It's kind of like very different here in Europe, where ETFs function in a little bit of a different way. They don't have the tax advantage that you guys have in the US, for example. We're lagging behind. But as a kind of like 30,000 foot view, how do you see it developing now that BlackRock, I think, has launched a managed futures ETF? Is it going to put all the mutual funds out of business at some point? Who knows? I mean, this maybe as a precursor before we get into the more technical stuff.
So we run both mutual fund and ETF-based return stacked strategies. The mutual fund strategies are able to trade a slightly wider and more diverse group of futures markets, because just operationally, if you want to venture outside of trading just futures markets that trade on US exchanges, then if you're trading an ETF and people want to make a market during the day, then some of the markets that you're going to want to make a market in to create or destroy, redeem units are not very liquid, as you know, when the people want to create or destroy those units. And so it's just not as operationally convenient. And you end up with the potential for larger kind of intraday slippage on trades for market making, et cetera, if you trade much outside the US markets and down the liquidity continuum. So there's definitely some operational features that you can deploy in a mutual fund structure because of the end of day, always traded NAV component of it that are more difficult to replicate in an ETF wrapper. But again, the ETF wrapper has some tax advantages. It has the intraday liquidity. It has the ease of platform access, et cetera. So it's just a bit of a trade-off and what people prefer.
Yeah, just to add a bit of color to that, there's what I would call strategy versus structure. And when you use the ETF structure versus the mutual fund structure, there are constraints, there are benefits, but also constraints. And Adam highlighted those, that when you're trading on the secondary, when it's exchange traded, there are market makers who are trying to hedge their exposure and keep tight bid-ask spreads. And when your underlying are illiquid or not trading or whatever it is, it makes it very hard for them to do that. And so what you tend to see is that, yes, we are seeing more active products. We're seeing more derivative-based products, and we can get into the regulatory environment that's allowing that. But most of the futures-based products that are coming out from Alpha Simplex and Man AHL and Invesco and BlackRock tend to be a subset of more liquid US and European traded markets than you see in their mutual fund or hedge fund products.
So that is a great segue into one of the questions, or some of the questions that I wanted to ask. So maybe, Moritz, can you hold your thought? Because I know that you wanted to ask questions about the replication methodology, but now that we're already speaking about the topic of, bid-offer spreads, and I think, Adam, you mentioned slippage, that is exactly one of the things that, comes to mind is when you put these markets, like let's imagine a trend following trading system, when you put this active strategy into an ETF wrapper, there is kind of like this limitation. Well, maybe theoretically there shouldn't be a limitation on the number of markets and like the liquidity of the markets, but in practicality there is, because if you're putting too illiquid markets into it, or if you're putting too many markets into that are trading in different time zones, some of which may even be closed when the ETF is traded in the US, you'll just have a very wide bid-offer spread, right? I mean, and you cannot trade the ETF at NAV. You have to cross bid offer when you buy and sell. So that is, can you put some color on how wide these bid offer spreads are? What do you see there? I mean, what's the usual range there?
So I'll talk to that a bit. So first I will say you can do NAV-based trading in ETFs. You have to work for wealth advisors who have access to an institutional desk through their broker. They can normally get a NAV-based quote that'll settle at the end of the day. You can do this in Canadian markets. You can do it in US markets. And normally you'd get a quote and the market maker might say, I'll fill you at NAV plus or minus a few pennies when you ask for a two-way market. Similarly, you can ask for a risk quote, and intraday, they'll tend to give you mid-price plus or minus a few pennies. So if you're trading substantial size, what we have found is actually going through an institutional desk, you can get incredibly tight fills. What's harder is when you're actually not trading substantial size and you're not going to get a risk quote for 1,000 shares, right? And that's where you can see bid-ask spreads of 20, 30 basis points on average. I don't think are unusual. And during chaotic markets and or economic news events, you can see it blow out further than that. And so I think that will be a fairly persistent feature of these types of funds. I don't think you're ever going to see real penny bid-ask spread as long as you're trading markets that are less liquid and you have daily trading, and the market makers don't necessarily have full transparency into what the basket is, right? The market makers are always going to, whenever there's less transparency, they're going to widen out and thin out. And so I think you tend to see that as a persistent feature of these types of funds. That said, I always like to say, well, you should only be entering the fund and never redeeming. So it's a one-way trade and hold forever, and that cost sort of smooths out over time.
Yeah, sure. You should have a longer hold period, of course, and not day trading any of these products. But staying with the number of markets and liquidity, I mean, ETFs in general, they are designed to scale into the billions, right? I mean, what constraints does that impose on the ETF in the sense that, I mean, imagine you're starting a strategy that includes orange juice futures and palm oil and, lumber. And then, you get to like 100 million or 200 million, you could probably remove those markets and make the underlying portfolio more liquid. Is there a way, say you're scaling it into 5 billion, 10 billion, is there a way where at some point you could force redeem investors or say, we're closing the ETF, we're no longer taking any more money? Because if there's not, and the ETF can, theoretically go into the gazillions, then, at some point you'll have 2 or 3 markets left to trade with.
I mean, we started with a universe that provided what we felt to be the right balance between ability to scale and sufficiently spanning the diversity of the potential bets within the future space, right? There are also things that you can operationalize to expand out the number of markets that you can trade with sufficient liquidity to get quite a bit more scale. So, for example, a lot of the markets have sufficient liquidity to trade within, for example, an ETF basket that we expect to scale into the billions. But there are CFTC limits that limit the number of contracts that can be held in the front month. But if you're able to trade back month contracts, then often you've got 10 times or sometimes considerably more bandwidth or capacity that you can trade in those markets that allow you to operationalize substantially greater breadth, right? But I mean, there's no getting around this trade-off. At some point, you're going to hit capacity levels where you're not going to be able to trade a meaningful proportion of the available markets at size that are going to make a difference to the P&L of the strategy over time, right? That's true for hedge funds. It's true for regular mutual funds, and it's also true for ETFs. Just there's a trade-off between accessibility, liquidity, and the diversity of bets that are available. And, all things equal, as we all know, the greater the diversity of bets in expectation, the higher the expected performance. What we do find, though, is, and I'll admit to being a little bit surprised about this when we first sort of began to do the research on this, you can get pretty darn close in replication space with a much more finite universe of markets, as long as you're spanning the equity index, bond index, commodity, and currencies. As long as you're sort of generally spanning those, even within a fairly liquid basket, we use kind of 26, 27 markets in ours. You can get really close from a replication standpoint to the performance of the full universe. And it's probably no surprise because everybody is impacted by the same set of constraints. In aggregate, all of these futures players can really only trade these markets in proportion to their liquidity, right? So if we're trading 26, 27 markets, they represent something on the order of 70 or 80% of total global futures liquidity, then you're just going to get pretty close to the average of what all of the different players are trading at any given time, right?
So to answer one of your questions really quickly that Adam didn't touch on is you can't close the ETF. So we have to be able to run it at, in theory, infinite scale. And one of the choices you have as an asset manager is to run the strategy differently at low size versus large size. I think that is a change of track record, right? We wanted to make sure that someone looking at the fund at $1 billion knew the fund had the same strategy at 100 million rather than trading markets that we were then going to take away. The reality is, if this got to $20 billion, I think it would sort of self-correct. By definition, the performance would degrade substantially, and people would start to take their money out. So there isn't the ability to scale to close. We've built it for substantial scale, but at the extremes, $100 billion in a strategy like this, it would just self-correct with performance.
Yeah, the market forces take care of it, right? And what you've mentioned, it's not technically style drift, but you are correct. If you're starting with kind of like 100 markets and it includes lumber and orange juice, and then at some point you remove these markets, it's a different thing all of a sudden, right?
Yes, you're
no
buying a
longer
different
the same product. Exactly right. Great. Moritz, do you want to talk about replication in more detail?
Sure. Back to the technical stuff. Yeah. It goes into a similar direction. And we already touched upon the subject of the trend component, which is part of many of the products that you have on the shelf. So speaking about trend, I saw that you are doing both top-down and bottom-up replication. And I was specifically interested in, is it kind of like coming from your proprietary trend system that you had before, or is that not usable in that context? Why did you decide basically to do both of the approaches? How do they work? And which index do you, for example, use? So which one is the one you're actually replicating?
Right. So I'll start with the bottom up because it, I think, addresses your question about whether it mimics the sort of legacy trend strategies that we have been running for many years. What we did was try to span as much of the potential space of how one might follow trends across the basket of futures markets that we intended to trade, right? As we all know, there's actually there are a variety of ways to define trends, but it is still finite, you know? So there's the kind of, call it classic quant time series momentum type approach. There's some moving average cross type strategies. The moving average crosses can be on or off. So something is above or below a moving average, or above or below the cross of the moving average, or it can be continuous where the signal, the size of the trend is a function of how far above a moving average of prices, for example. And then you've got these sort of breakout style strategies, which I know you guys are very intimately familiar with. And within the breakout style strategies, now you get into all kinds of degrees of freedom, right? You've got are you scaling vol all the way along? Are you only scaling vol on the entry? Do you have a trailing stop? If so, how far? So once you sort of enter into the event-driven style of trend, which you guys are more familiar with, the degrees of freedom explode. So what's interesting is within the sort of time series and moving average style trend, well, if it's kind of like you can model a moving average cross by weighting, for example, longer term moving averages positively and shorter term moving averages negatively, right? And so just the weight that you give to the different trend lengths end up allowing you to model a variety of different continuous style trend strategies. So what we did was we just took a time series trend approach. We applied it to each individual market. And for each individual market, a variety of trend lookbacks from kind of 5 days out to, call it 300 days. And then we regressed all of these individual market, individual trend length strategies on the Société Générale Trend Index over the very long term. We've got daily returns going back to 2000. And we saw what proportion of the strategies at different trend lengths for different markets were required in order to provide the best long-term fit to the trend index. And what we found actually is that and keep in mind, the trend index is an average of 10 funds. All these funds are doing things slightly differently. Some of them are going to be more sort of breakout style. Many of them are more continuous quant style. But as we model the fit across the average of all of them, the bottom-up strategy actually does just a really good job with an average correlation, daily correlation in the neighborhood of kind of 0.8, right? So why don't I stop there on the bottom up, because you probably have questions already, and then we can get into the top down afterwards once we clarify.
Can I do a 30-second summary for the less technically inclined?
Please.
The 30-second summary here, right, is when you talk about trend, we're all generically typically talking about the same thing, but the implementation details really create a lot of dispersion in the space. Anyone who's looked at the trend space knows there's a ton of dispersion. And that comes from what markets are you trading? What trend speeds are you trading? How much risk weight are you giving each market, right? What sort of constraints are you putting on? These are all choices that you can either make discretionarily, you can try to do some sort of fit, right? But that's what leads to the dispersion in the space. What we did in designing our bottom-up model, which is just a trend following model, is all those parameterization choices came from the objective of how do we create a long-term system that looks as close to the SocGen trend index as possible. So how much risk weight we put in oil or gold or the euro or dollar or the S&P, what trend speeds we're trading oil and gold and the S&P, all of that comes from trying to fit the long-term performance. And what you get out, I think, is actually, it's not a secret. I think it sort of rhymes with what you could guess. You get intermediate term trend speeds, and you get 25% of your risk weight pretty much in equity indices, in bonds, in commodities, in currencies. And within commodities that we trade, it's split pretty evenly between metals and energies. And my guess is you guys have lived in the space long enough, you would guess the average generic trend follower is putting equal risk weight in the major sectors and categories. And that's what we found came out of our fit. So it's, when we talk bottom up, we're running a trend program. It's just all the parameters were chosen to try to fit what sort of the average trend follower looks like.
Would you at some point recalibrate that fit? Like, this is when you think about the opposite, which is the top-down replication, you have that responsiveness to, changes. As underlying managers change, hopefully you'll be in a position to pick it up. With the bottom-up approach, you don't necessarily have that response function. It's not built in, right? So it could be that some of the trend managers that are included in the SocGen trend index start trading differently, or start trading different markets, or I don't know, become shorter term again. Who knows? We don't have a crystal ball. How, would you rerun the model, recalibrate it annually, or is it kind of like set in stone? You've disclosed it, that's it.
I was going to say it's a non-trivial problem, right? Because I 100% agree. What if every trend manager goes from long-term to fast trends over the next year? When you fit a model like this that has so many parameters, you need a big depth of data. And the other thing you need is for all the markets you're trading to have gone through meaningful periods of contributing positive or negative P&L to the system. And what you find is, if you were to just train on 2000 to 2010 and compare that to just training on 2010 to 2020, you will actually get some pretty different weights, risk weights in particular, for different markets. And it's because the system is having trouble figuring out whether the trend follower simply didn't trade a market, or whether the market just never really contributed to P&L over that period. And you can have something that contributed a ton of P&L in one decade and no P&L over the next decade, meaningfully contributing to the variance of the system. And depending on the period in which you fit, it will look like trend followers don't even have that in their system. And so what we found is, to get a good long-term average sense of what they're actually trading, you really do need 15, 20 years. And so we can keep rerunning it every year, to try to update, but it's not going to meaningfully change the weights.
We also, when we were investigating this, did analyze the extent to which the weights on the different markets and trend speeds changed depending on the time period that was used for training. And we also ran what you guys will be familiar with, some, a variety of different cross-validation type tests And yeah, I mean, to Corey's point, you did have some periods where one or two markets didn't represent as high a weight, but the sector weight was still very consistent. A good example is the 2000 to 2010 period. ES actually had a very low, like just ES systems. S&P 500 had very low or lower weight in the portfolio. And I don't know, anyone who lived through that period knows that the S&P just wasn't really trending in that period. And so trend systems didn't hold a lot of S&P because it largely went sideways and was trendless. And then from 2010 to 2020, the S&P was massively trendy, mostly trending up. And so the trend systems had a much larger weight in them, right? But if you train on 3/4 or 80% of the data, no matter how you slice the data, the trend weights, both in terms of sector and individual markets, and the weights on trend speed, all look astonishingly similar. There actually isn't a meaningful difference. And if you try to evaluate whether there's been any sort of systematic bias in, for example, trend length over time, because I think there was quite a bit of hypothesis that the trend length for systems between 2000 and 2020, for example, increased systematically over that time period. We actually didn't notice any meaningful evidence of that. So that we perceive that as kind of largely mythical. So, in general, we found that it just generalizes very well.
Did you run into some trouble with using a limited set of markets? You mentioned 23 to 28 in the beginning that you're using, but you're replicating an index which, I don't know, might have managers who are substantially in other markets, because we know from some managers who were saved in some of the years just because they traded in sugar, for example, which is something I guess you don't have in the portfolio. So how does that show up? Does it make a difference overall, or kind of like, is it in aggregate just not that much of an impact?
I mean, the thing about the trend index is it captures the performance of the largest managers by AUM. And therefore, as we've already discussed, as you grow in AUM, the less liquid markets that you trade end up having a smaller impact on total portfolio P&L. So, by virtue of these funds being so large, these managers, I guess, have actively chosen to not constrain AUM, to build strategies that scale. And so we're replicating the strategies of managers who've already built strategies to scale, right? And so I think from that perspective, we would expect there to just be less contribution in aggregate as you replicate the managers in that strategy on average. There's just less idiosyncratic bets that are materially impactful. And we just, obviously from month to month, quarter to quarter, we do see some of that dispersion. Coffee was a big one in 2024, in 2023. Some managers obviously did just incredibly well. But on average, in the index, the managers just didn't have in aggregate a very large bet to it, right? So we did see some dispersion because that bet has now rolled back, and a lot of managers who did benefit from it are now giving back a substantial amount of those gains. So now we're seeing positive dispersion where we saw negative dispersion before, right? So I think what we've observed is just on average, it balances out over time.
One way to think about this, right, is, again, these are large managers. Let's say they trade a long fat tail of markets, 70, 80, 100 markets. 80% of their risk weight's probably in the same 20 markets we could all rattle off the top of our head. And 20% of their risk weight is in this fat tail. Unless their signals are all perfectly correlated to each other, though, when you start to average those weights together, right, it's going to attenuate towards zero. And so what you end up finding is, and then you have to consider, does that fat tail have zero correlation to the markets we're already trading, or does it have some overlap? And so as you sort of say, okay, there's probably some correlation with markets we're already trading. It's not perfectly independent. and those weights are going to attenuate towards zero because not all the managers are perfectly, trading the same signals, you end up with a situation where that 80% really does explain a huge proportion of the variance of again, their average performance. We're trying to deliver the beta of the category, and we're trying to outperform that over the long run through fee differentials. For managers that are trying to truly add alpha, I absolutely understand the desire and want to trade the fat tail of markets, and that's exactly what we do in our mutual fund offering. But an ETF that needs to be scalable, and we're just simply trying to deliver trend beta, which we think is an incredibly compelling proposition on its own, what we have found is the beta can largely be captured with just a handful of the common names you would expect.
And to capture the beta efficiently, I think you guys run two models, right? You have a top-down and you combine that with a bottom-up. What was the thought process behind that? Do you think that just, the combination of the two is going to, generate greater stability in the replication process? Or is it kind of like, oh, you don't know which one is the better one? So kind of like, place two bets, see what works? Because you could have made a choice, right? And said like, okay, we're doing bottom up, that's it. Because as you said, Adam, you have 0.8 correlation to the space, which is, great. You could just go with that. So maybe give us some background on why you combined the two approaches.
Yeah, so the top down, just to get everyone on the same page, is a regression-based approach, right? Where we're going to look at the most recent performance of something like the SocGen Trend Index and run a robust regression to say what mixture of futures markets, trading long and short, what basket would have given us very similar performance to the index or a mixture of managers. And then we're going to assume we can hold that one day forward, that these managers aren't making substantial changes day to day, that the prior weights would have been close to the next day. And we'll keep rerunning that evaluation on an ongoing basis. The pros of this method are that it's incredibly flexible, right? And you touched on this earlier, Moritz, that we don't actually care how the managers are coming up with their weights. They can innovate all they want, and we should capture that innovation over time. We're just trying to say, what is the result of their process on average? What do the average weights look like across all these managers? The other really interesting thing about the top-down approach is that it can capture the return of markets that we're not necessarily trading because of the way regression works. So, for example, we don't trade the Swiss franc, but if the return of the Swiss franc can be pseudo-approximated by a linear combination of, say, gold and the euro, right, and P&L is coming from the Swiss franc, our regression process might by a combination of gold and the euro to pseudo-approximate that Swiss franc. And so it's a very flexible approach. The con of this method is it is by definition rearward facing, right? So you have to look at 20, 30, 40 days. Now most of the time trend followers aren't changing on a dime, but every once in a while they do, right? The regional banking crisis of 2023 is a good example where managers went from very short bonds to almost flat to long bonds in a 2 or 3 day period. You're not going to pick that up immediately in that look back process because you're looking over those 20, 30, 40 days. The other issue with this type of approach is that, and we touched on this in building the bottom up system, if a certain market doesn't contribute any P&L or contribute to the variance of returns over the last 20 or 30 days, the system has no idea how managers are positioned, right? So just as a hypothetical example, imagine coming out of 2022, every manager is short bonds and then bonds flatline for 20 days. Those managers would likely still all be very short bonds. But if you're just looking at the last 20 days using a regression process, the regression is going to go, I have no idea if they're long, flat, or short. Now, there's some things you can do to sort of manage around that, but that is one of the problems. And so what we said was the top-down approach works. We can build this and we have great conviction that it works, but it's also untethered mechanically from trend following. What if we complement it with another system? And that's when we built the bottom-up system. And we think the pros and cons of the bottom-up system are almost the exact opposite of the pros and cons of the top-down. And what we find from a tracking error perspective and a correlation perspective is that the two systems are almost identical. They're statistically indistinguishable as to which one is better at achieving its objective of sort of tracking that average trend beta. but when they have tracking error is fairly uncorrelated. Like I think a correlation of only like 0.2, 0.3. And so by definition, we are better to combine the processes together to bring the aggregate trend tracking error of the system down. So what we do is every day we run that top-down system, regression-based system, get a target set of weights. We run the bottom-up system, which is a true mechanistic trend following process, get a set of target weights, blend them together, and that's how we come up with the target weights for our total system. And so when a lot of people talk about replication, and I listen to this podcast quite frequently, they often say, well, it's totally divorced from trend following. Our bottom-up process, which is the majority of the weight, we weight it 30% top-down, 70% bottom-up, is a trend following strategy. Our replication approach is truly applying trend following signals. I think a lot of people get that wrong when they talk about replication. We just find that the top-down does seem to work just as well as the bottom-up and provides process diversification. And so we find it's better if we blend them together.
If you had to choose just the bottom up or the top down, the bottom up has a better track record of stronger average fit. But the top down sometimes completely overwhelms the bottom up in terms of capturing probably idiosyncratic systems or methods that are being applied by these individual funds that are just not captured in the continuous time series trend that we're modeling in the bottom up strategy, right? So in a very real way, the top down is an expression of epistemological humility. Like we just know that there's constant innovation happening in the space. We don't know everything there is to know about how best to follow trends or trade futures markets in general. And so we want to be able to capture some of that innovation, some of that dispersion in thinking among the individual managers, and the top down gives us an opportunity to capture that.
When you run the top down on the SocGen trend index, I think, Corey, you've aptly used the term, it's kind of like tethered in trend. I mean, at least you'd assume the underlying managers to follow a systematic, diversified trend following trading strategy. Now, in the case of the SocGen CTA index, not the trend index, the other one, the big one, trend does play a significant role, but it's not the only source of returns. And managers have changed during the past 20 years, like the trading VIX contracts. Maybe there's some more of mean reversion going on. It's kind of like there's different source of returns, maybe a noise term or something like that you now, enter into the regression calculation. Do you think that makes it easier? Because I don't really have the answer to that. It could actually make it easier to work with a top-down approach and find the best fit.
I'll say it makes it harder to do the bottom up for sure, right? The reason
harder to do the bottom up, no doubt about that.
Yeah, the top down, I would have to think a little bit more about that. Depends on some of the speed of the models they're using. Like if they're using faster mean reversion models, it could be very difficult to pick that up because if you're trading, 20, 30, 40 contracts, even if you're doing a robust regression method, you still need enough data to get that fit. And if they're trading daily, multi-day mean reversion models, it's just going to be very hard for you to capture that effect. And so maybe you just leave it aside and you are ultimately just capturing predominantly trend, which is still highly explanatory of the broader CTA index, but that might not be the case over time. And so I think like our mutual friend, Andrew Beer, right, runs a strategy that replicates the CTA index. He only uses a top-down approach. I don't think that's wrong. I think it'd be very hard for him to build a bottom-up approach that captures trend, carry, mean reversion, intra-market signals, all this stuff that is happening in the broader CTA space that gets captured in that index.
I think it's an interesting question, though, an area of exploration. I mean, we run systematic global macro multi-strats, right? So we run skewness strategies, carry, relative value carry, seasonality of various types. So we have all of these underlying signals that we can use as explanatory features in a bottom-up context. We've run those features in a bottom-up context. They do help to improve the explanatory fit of our bottom-up model. They improve the explanatory fit against the CTA index to a larger extent than they improve it relative to the trend index. To your point, because the CTA index, the managers in there are using a wider variety of signals in addition to trend, right? There's some question about if we're trying to express a trend following index, whether we should include non-trend features because those features do improve the fit. The good news is against the trend index, the improvement in fit is marginal, so it's not really that hard a decision. If we were trying to replicate the CTA index, we'd have a harder decision, I think, about the breadth of the different feature families that we might want to include in the bottom-up replication process.
I think the way I view it, with all the sometimes critiquing that goes on about these ETFs, we're not critiquing anything here. If anything, we accept it as a new and fair benchmark, to be quite frank. If you are a hedge fund that is charging performance fees in that space, and you're supposed to produce alpha, you better beat these ETFs who replicate, as you say, or who give cost-efficient access to the beta of our industry without charging performance fees. So I guess that's just, that's the bar. If you want to be in the hedge fund business with a performance fee, charge 2 and 20 or whatever it is, you better jump over that bar. Maybe not every year. There's always a luck component to it, but over the longer run, you just need to be better than the ETF, period.
Or offer something different, right? Quantica had a great piece that I revisit very frequently that talks about, the benefits of adding a longer tail of markets. And they have this interesting trade-off of, the more diversification you have, the improvement to the Sharpe ratio makes the strategy look more absolute return. But actually, because you're putting so much of your risk budget in this longer tail of markets, you don't necessarily get the same crisis offset that CTAs have historically delivered. I hate that phrase, but I'm gonna use that, right? Because you're not putting as much into the markets that may necessarily be correlated with the big economic factors. And so I think one of the really interesting trends we're seeing in this space is people saying, well, the beta is the beta. The beta is pretty cheap. I mean, I've talked to institutions who try to get the beta, in QIS from banks for 10, 15 bips, right? They really look at the beta as being like equity, like beta at this point, because of how trivial a very naive trend strategy is to implement. So you go, okay, well, what else can you do? You can look at spreads, right? You can look at, do you use breakout systems? Do you design your system to be faster? Do you design certain constraints so it has better diversification properties? Do you do what Floor and Cork does and do pure alts, where maybe it's a very vanilla trend strategy, but just getting access to that fat tail of markets is actually very operationally difficult? I think there's a lot of innovation that can happen in the fat tail of the space, that there's still huge room for hedge funds to continue to charge their 1 in 10 or 2 in 20, whatever they want to charge. But I think those hedge funds that are doing very generic trend, I think you're right, are just going to get squeezed out by lower cost, more efficient data implementations.
Yeah, market forces at play, and I think that's just fair and square, to be quite honest. We like trading some of these, you call them feather-tailed or potentially feather-tailed markets, alternative markets, whatever. I don't necessarily like that term. I think they're all markets. They're just different markets. Some of them are a little bit more operationally heavy lifting to access than the S&P mini futures contract. But then it's also spreads, synthetic markets, stuff like that creates a difference. And we also think that the punchiness of returns creates a difference. Most of the funds in our space have lowered their volatility profiles in recent years, in the recent 10 to 20 years even, to a level where it's, between 8 and 12% volatility, and it's volatility controlled, and it just no longer looks like the CTA returns in the 1980s or early 1990s. But those were, I think, very valuable, especially during times of stress. So the question is, how much bang for the buck do you want to get when you need it? Obviously, last week, we would have liked it. I mean, we're recording today on 15th of April. 10 days ago, we had a little bit of a drawdown event, I guess, in the CTA space. We'd like it to be different, but who knows? I mean, this is only the early innings of something that's happening in the market, where maybe in 30, 40, 50 days, we'll be out of our drawdowns and making good money.
Well, this brings us actually full circle back to portable alpha in a way, because a very high vol trend strategy, right, can just be thought of as a more capital efficient low vol trend strategy, right? If you've got a 50 vol trend strategy, I can allocate 1/5 the capital to that and effectively get a 10 vol strategy versus, just buying a 10 vol strategy. And so at the extreme, an incredibly high vol trend strategy, ignoring sort of like the knockout leverage risk there for a moment, right? You take it to sort of infinite vol and it becomes a portable alpha overlay. The reality is, though, and I think Cliff Asness has talked a lot about this, is like just most clients can't tolerate more than 10 vol. So even if you say to them, hey, this is a 50 vol implementation and you only have to put 1/5 of your capital in, and that gets you a 10 vol overlay, there's the line item risk is still too big in this industry, and those products tend to struggle. And so that's why I think you've seen all the major players move to the 10 to 12 vol, because that's what the institutions and the institutional process can handle.
It has become that. I think 20, 25 years, it wasn't like that. Moritz, I think you want to, in a second, answer a question or put a question to what Corey just said about the blowout risk, which we think is very interesting, a very interesting thought in that space. But I agree with you, Corey. The pain of 20% volatility or 25% volatility and the potential drawdown that could come with is something that most investors can no longer tolerate. Whereas 25 years ago, the S&P 500, most equity markets, they kind of like had 20% volatility all the time and everybody was fine with it. Something changed. Something changed in the institutional allocator space where 20% volatility is no longer fine. It has to be dialed down. It has to become less. But obviously that is not without consequences and side effects. But let's speak about the risk of ruin, Moritz. What do you think?
Yeah, Corey already mentioned it a little bit, right? How far can you go actually with stacking different strategies that might be correlated, especially if one of them is like, for example, higher volatility. So how do you manage that, especially in an environment like last week where we have equities going down and then trend also doing what trend does, also being down. So is there a limit to kind of like what you stack? I guess you would not combine things that are closely correlated. So usually we know that equities and trend is not too correlated. So it's a good diversifier. So it lends itself to stacking. And there are some other categories where you would probably avoid stacking them.
Adam, why don't I talk about regulatory here, and then you talk about like practical margin management and what we saw maybe last week. So from a regulatory perspective, there are actually some limits here when we think about implementing these ideas within an ETF or a mutual fund. And I'll try to make this part fast because I don't want to bore the audience and put them to sleep. But there's a rule called the SEC 18F4 rule. This is also known as the derivatives rule that was put into place 3 years ago now, I believe, that governs how ETFs and mutual funds and closed-end funds can use derivatives. And if you're going to use derivatives like options or futures, you have to follow this rule. And this rule is a VAR-based risk rule. And it basically puts limits that say you can only have a 20-day 99 percentile VAR of either 20% or 2 times your relevant benchmark. And so depending on what product we're bringing to market, sometimes we use the former rule, sometimes we use the latter, but it does ultimately put regulatory constraints on how far you can push this stuff. I think from a true operational perspective, you can push it much further than what the regulators allow, but there is a regulatory cap on how far this stuff can be pushed and how safe the SEC wants to keep these ideas. So Adam, maybe you can take it from there and talk about a little bit of our experience last week of maybe specifically stacking trend, a 13.5 vol trend system on S&P 500 and how we managed the margin there.
So the strategies are rebalanced every night, right? So imagine you're starting at $100. You've got the strategy experience is a $3 loss. Now you're at $97. Well, now you've got $97 worth of S&P, and you've got let's call it a stocks plus trend type strategy. You've got $97 in the S&P, and you've got $97 in a 13.5 vol targeted trend strategy, right? So you've lowered your exposure to both in recognition of the fact that the total value of the portfolio has declined, but you're also maintaining the balance between the $1 of S&P and $1 of trend, right? So because we're constantly rebalancing both, the underlying exposures within the trend strategy and the relative exposures between the beta and the alpha that's stacked on top, the risk of ruin is fairly negligible. And also, I mean, we only need at maximum kind of 25 or 30% of the total portfolio value to collateralize the trend overlay at any given time. And we keep, 40 to 50% in cash. And to the extent we want to, for example, have a 100% in the S&P 500 as our beta, well, a portion of that is going to be allocated to an ETF to get that beta. And then a portion of that is going to be allocated to cash, which is going to collateralize the futures trading. But also, we're going to have what equates to another 50% exposure to the S&P 500 via S&P 500 futures, right? So there's always more than enough collateral. There's a balance between, we want to have as much allocated to cash funded beta where it makes sense, for example, in equities where it's more cash efficient as possible, while making sure that we've got plenty of collateral available to collateralize the future strategy in the event that we have a drawdown in one or the other or both, like we experienced last week. And so, if you go back and audit the performance, the margin assumption, the relative balance between the beta and the overlay of the ETF strategies, there was just no dislocation at all. There were some days where we had, going into the day, we had slightly more S&P on the books or slightly less S&P on the books, just by virtue of the fact that the value of the S&P component had moved overnight, right? But these are just the normal course, operational realities of managing a fund.
All of this is super interesting, and we're speaking for almost an hour already. Even though trend following is near and dear to, I guess, all of our hearts, I'd like to speak about, because you also have multi-asset carry, you have, different types of return streams that you can stack. One that I'd like to speak about is, I'm just picking that as the merger ARB piece, which I think is probably one of your later additions, right? You don't have that around for too long. If you could just explain, merger arbitrage, risk arbitrage, if you could give us kind of like, how do you do this? Is it systematic? How do you pick the targets? Like, just give us the high level overview of how that works.
Yeah, so really high level, right? Merger arb, for those who aren't as familiar with it, the idea here is that when there's a public announcement of a public company being bought, there's typically an announcement of a share price at which that public company is being bought out at, and the price of the stock will jump up towards the buyout price, but it typically doesn't get all the way to the buyout price. And there's two components of why it doesn't get all the way to the buyout price. The first is simply the time value of money. The deal is not closing tomorrow. It's probably closing sometime in the future. There's some unknown time in the future, though generally somewhat scheduled out. And so, right, you're going to discount that future known value back to the present value at the appropriate rate. And so that's part of it. There's a time value of money. And then there's sort of a credit-like feature, which is, well, what is the risk that the deal falls apart? And the less certain the market is that the deal is going to happen, the larger that spread is going to be. And so merger arbitrage is in its most naive form is when a deal is announced, merger arbitrage strategies will go in and buy the deal post-announcement and basically try to capture the spread over time, taking on the risk that the deal falls apart. And so it's often most frequently looked at as a true risk premium. People who will offload the shares after the announcement to people who are willing to bear the risk of the deal falling apart. And so you should earn some sort of risk premium very generically implemented strategies have historically earned somewhere around 200 bips over SOFR over the last, say, 20 years, 250 bips over SOFR. The returns of a merger arb strategy are, interestingly enough, pretty lowly correlated with other popular strategies, whether it's the equity risk premium, bond risk premium, or credit risk. Probably about a correlation of just 0.5 to the credit risk premium. And so as another diversifying return stream, we think it's a pretty active, interesting diversifier. We found a team out of Israel called Alpha Beta. They had been running this type of strategy in a hedge fund for a couple of years. And we worked with them to take their approach, which is systematic, and it's a machine learning based approach to actively screen US listed deals and turn it into an index. So we then license that index. It's called the Alpha Beta Merger Arbitrage Index. And that is how we implement our strategy. It is a much more concentrated approach. They basically define the universe, US listed only deals. It has to be certain deal size, deal type. And then after that, they're using a machine learning model to look at effectively the quality of the deal. How much spread is left? What's the acquirer look like? What industry is it in? All those sorts of features go into the machine learning model to say what the expected return is pricing out at. What's the probability the deal closes versus the deal falling apart? What does that imply for the expected return? And the expected return has to overcome a certain hurdle rate to be included in the index.
I think you implicitly answered one of the follow-up questions I would have had, which is, are you hedging this, in air quotes, with a short leg of the acquiring company, which I presume you're not doing the way you've explained it. I think
we actually are. So
you are.
So
okay.
The vast majority of deals are cash deals, in which case you don't have to hedge the short leg. When the acquirer is a public company and there is a share component, we will hedge the appropriate amount by going short.
Okay, that is an interesting part inside an ETF because you have to locate the stock, borrow fees, the short leg might be called away. I mean, what if GameStop wants to use its shares to buy MicroStrategy? You'd be, long MicroStrategy, short GameStop. I mean, that could be a life-ending experience.
That would get screened out. But
yes.
What's interesting there, right, is our flexibility because of who we partner with to bring these products to market is we can do specific short location, but we can also get these names on swap.
Okay.
And so in certain cases,
you don't get called away.
We look at whether it's more effective to actually explicitly short or get the short on swap.
Excellent. Great. Look, before we come to an end, Moritz spotted on your website that you have something going on with gold and Bitcoin. So maybe the last 2 or 3 minutes, we'll touch on that. That's always interesting and exciting.
Yeah, and I have a specific question to Corey, how this product came alive and why. I have a theory, and my theory is kind of like from the Twitterverse, right? Corey missed out on the hyperliquid token drop and wanted to get as close as possible to launching something. So kind of like mixing in gold and Bitcoin is the best thing that you can do in the return stacked world. Is that true, or is it kind of like completely the opposite? You just want to mix digital gold and the real gold.
Yeah, I think it's painful when everyone brings up that I missed hyperliquid, given how early I was to that. It's a bit of background lore on me for those who know what hyperliquid is. No, this for us, as we continue to look to expand our suite of products, we actually had this product on our roadmap very, very early. Probably should have launched it earlier than we got around to launching it. But what we're really looking at doing with the Return Stack ETF suite is bringing these building blocks to the market, right? We have an equity plus trend. We have a bond plus trend. We have a bond plus merger arb. We have equity plus multi-asset carry, bond plus multi-asset carry. As we continue to look at what we think are interesting diversifiers, right? There's diversifying strategies and there's diversifying assets. And I think both gold and Bitcoin, particularly with the thematic narrative of store of value, are interesting potential diversifiers that are hard for people to carve out room in their portfolio for, but may make interesting overlays to the portfolio. And so for us, we say, well, what if we bring a product to market that provides, you give us $1, we'll give you $1 of US equity plus $1 of a gold and Bitcoin portfolio. actively managed, but not actively in like a trend following sense, more in just balancing the risk between those two components, so that people can introduce both gold and Bitcoin as an overlay to their portfolio. And so for us, it just falls into that diversifying asset bucket, not really a diversifying strategy the way we're doing other approaches. But we, again, we think gold in particular, and I think Bitcoin is proving some of these features, can be a very interesting long-term diversifier for a stock bond portfolio.
Excellent. Well then, thank you for joining the two Moritzes for the first time on the podcast today. We really liked it. I hope our listeners will like it too. It's been a pleasure speaking with both of you. And as usual, listeners will include the most important points of today's discussion in our show notes. And should you have any questions, we always welcome them. We also welcome listener feedback. Please send us an email to info@toptradersunplugged.com, where we'll pick it up and respond. Thanks again for listening, and we'll see you next time on Top Traders Unplugged.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.